You did it! You saved that down payment and now you're ready to buy a house. But which mortgage is the right one? Well, I'm going to break them down for you today. It's important to make sure you work with a mortgage broker that has your best interests at heart. But how great would it be to sit down already being an educated consumer? Stick with me. This will get detailed, but I'm going to try very hard to keep it simple for you. First, fixed rate versus adjustable. In a low interest rate environment, fixed rates are often the rage, but as interest rates start to rise, adjustable rates start to gain more appeal. The temptation with adjustable rate mortgages, aka ARMs, is that they are a lower interest rate, at least to start. Often these come in the form of a 5-1 or a 7-1 ARM where the interest rate's fixed for the first 5 or 7 years and then they adjust annually each year after that. This can lure you into a situation that's not favorable, and then later, when it's time for them to start adjusting, you're left scrambling to refinance, and by then fixed rates are usually higher and you may find yourself stuck, especially if you can't qualify as you expect for a myriad of possible reasons. Don't risk later losing a leg, just lose the ARM now and stick with a fixed rate. Second, conventional. Conventional is called that because it's exactly that, conventional. This is often the mortgage with the least fees and strings attached. Often requiring 20% down to qualify, it is usually the best option, and it's more favorable because of the fees, helping you avoid PMI, helping reduce your mortgage payment because of the amount required down, and more. Conventional is a surefire way to get a loan you can most often actually afford. Third, FHA. The Federal Housing Administration designs these loans to appeal especially to the first-time home buyer. Only requiring a 3.5% down payment may sound attractive, but can often be a recipe for buying too much house. You're also stuck with PMI for the full term of the loan. That can add on $100 a month per $100,000 borrowed. No, thank you. A low down payment, government tax incentives, and more may make homeownership seem like a very easy goal to achieve. That doesn't mean it's the right solution that is really in your best interest. Fourth, VA. Specifically for military veterans and backed by the Department of Veterans Affairs, it allows for buying a home with nothing down. However, there are lots of extra fees and higher interest rates than a conventional mortgage. Also, with nothing down, should a market change cause housing values to dip, you could quickly end up owing more than the house is worth. The intentions here are good, but the system's all wrong. Fifth, USDA RHS. The U.S. Department of Agriculture provides a specific program for rural borrowers of certain income levels. It's managed by the Rural Housing Service. It's subsidized based on your income, and then what they pay towards it is recouped when the house is sold or refinanced, and very aggressively so. There are prepayment penalties and other restrictions. Honestly, it's designed to get people who really shouldn't be homeowners into a house. This is definitely one to avoid. Sixth, reverse mortgages. This is where the lender's paying you a monthly mortgage payment and you sell them your equity in return for those payments. This arrangement is popular with the elderly on fixed incomes who didn't prepare well for retirement. It's very dangerous. With a traditional mortgage, the grand total goes down over the course of the term, but with a reverse mortgage, the total rises over time as your interest accrues. You're putting your home at risk, the fees are terrible, and you should really ask yourself, why would you risk what's already been paid for just to have more income in your pocket? Run from reverse mortgages. 7, accelerated or biweekly payoff. The idea here is to make extra payments so it pays off the mortgage sooner. It may be weekly or every 2 weeks. Making extra payments is a fine strategy if done appropriately, but there's for sure no reason to pay the lender an extra fee just to operate in this mode. Not to mention, if this is how the loan is structured to begin with and you want to change it later, you're going to have to refinance. You can make a proactive plan without going this route. 8, interest only. In this situation, the buyer takes out a mortgage loan and only makes interest payments for the first 5 or 10 years. Then the buyer makes both principal and interest payments, and the interest may vary. Eventually, payments become a lot higher. This is one of those creative loans type schemes that got people in real trouble when the 2008 housing bubble burst. When it comes down to choosing a mortgage, I hope you now feel more educated and equipped to guard against some of these very poor options. My recommendation is to stick with a fixed rate conventional mortgage that equals a mortgage payment around 25% of your take-home pay while avoiding PMI. For more information on this aspect, check out my previous Savvy Saturday video, a simple 4-part recipe for secure home ownership. I hope you found this information helpful. Make sure to download my free ebook, The Money Finder, which helps you save in 6 major expense areas, and come join me in the Strong Together Money community. It's my free Facebook community designed to keep you focused, informed, and growing on your financial journey. This has been Jeremy with Strength in Numbers, helping you find more money to fund your dreams.